Hey, everybody, welcome back. Today we're going to demystify Joe Biden's administration's tax proposal for estates and essentially decedents who have passed away and the implications that may have on you as a beneficiary or an executor running an estate. The interesting thing about this is currently these proposals are pretty much dead on arrival. They're not going to be implemented before the new election that's coming through. But this is a caution to you who are going to be voting that if Joe Biden does become president, these are the initiatives that he wants to have enacted for people who are passing away and for their loved ones who are inheriting assets. So one of the key reforms that they are talking about, and they're doing it a little bit dishonestly, is the removal of the stepped up basis concept. So when somebody passes away, all of their assets technically go to an estate tax return and are taxed. Well, there is no filing requirement for an estate tax return if you have your total asset values and you subtract your lifetime exemptions that are left over after your gifting throughout the year. If that total value of the tax due is zero, there is no requirement to file. But per the law, you are actually taxed on all of those assets. You're just coming in and you're removing that tax bill with that lifetime exemption. So because per the law it is taxed, our laws have been written that if you tax something, you can't tax it again. And so once it's taxed at the estate level, even though there's no estate tax paid because of this exemption amount or this exclusion amount, it essentially is deemed as taxed. And thus all of the assets that that decedent owned are going to be getting a stepped up basis because it was already taxed. So there was tax paid. Now, this is an important concept because a lot of people are running around stating that, well, you know, if a daughter inherits $6 million in assets, she never paid any tax on that. Well, technically she did because it was taxed at the estate level. And if there were tax, if they repeal that exclusion to a lower amount, there would be tax due on those assets that trigger that stepped up in basis. And so that daughter, her share would be reduced in the estate assets she would receive because the estate has to pay the taxes. So again, because the estate is going to be paying the taxes or because the assets are taxed, they get that stepped up value. And so she shouldn't have to be paying any tax on that, but the estate might if they repeal that exclusion and exemption to a lower amount. So that's the way it currently works. And it is in line with the tax law. If you tax something, it shouldn't be taxed again. So what the Biden administration is proposing is they are proposing that when somebody passes away, it's actually going to be triggering an income tax event. So this isn't taxing wealth. This is taxing an income. So if somebody passes away and they own an asset that's worth $10 million and they have, let's say it was an apartment building. They have that apartment building. It's worth $10 million. Their basis, their cost basis in that, maybe they bought it for $5 million. So there's $5 million of basically value creation there that the Biden administration is saying once that person passes away, that is an income tax event. So how they want this to work is on that decedent's last tax return, they're going to treat that as a sale of the assets for $10 million. And there will be a $5 million gain on that decedent's last income tax return. And so what that effectively is going to do is it's going to force the hands of executors, personal representatives, to basically set aside money to pay that debt, because now there's going to be a lot of people owing money on all these assets that have appreciated either through inflation, value creation, you name it, whatever. It's going to trigger a huge tax bill. And ultimately, in most cases, it's going to basically force them to sell that income producing asset at that $10 million fair market value or whatever it's deemed, just to pay the tax bill, because you're going to be encountering people who are going to be inheriting things such as rentals, businesses that don't know how to run them. And then they're going to be faced with this large tax bill that's coming up. And they're just going to wipe their hands clean of the family business, the family rentals, just from the stress of the tax situation, from the stress of trying to learn something new to run it. And it's just going to be challenging overall for families. Now, currently, to make this more palatable, there are exclusions for heirs that do inherit businesses. There are also sections to where you can pay this tax over 15 years if you have non-liquid assets. And so really, you can look at this as the start of a change of something we've had around for, at this point, it's been over 100 years. I believe the stepped up basis concept has been around since the inception of the Internal Revenue Code in the 1920s or so, around there. So to say that you have income tax event when somebody dies is quite the change from what we are used to. And quite honestly, I don't know how the courts will reconcile that with some of the precedents that we have in other cases. So it's going to be an area that a lot of people are going to be looking at. Right now, not too many people are paying attention to it because, again, it doesn't seem like it's going to be going through at all. Not too many people are interested in talking about this at this moment. But if the Biden administration gets in 2024, 2025, going forward, when they're going to start talking about the Tax Cuts and Jobs Act again that Trump implemented and it expiring in 2025. If Biden is president then, for sure this will be talked about, because they will probably redo a lot of the things that Trump did with the Tax Cuts and Jobs Act. So to give you a kind of a quick overview of how this works, this is an example that was presented to me in one of the tax letters that I subscribe to. So let's just say Amy, her dad, dies, and he bought a stock years ago for $300,000. It's now worth $7 million. Now that is a $6.7 million gain, so appreciation in that stock, that isn't subject to any tax under the current law, because those assets would roll over to that estate tax calculation. And because we're at about a $12 million exclusion right there, depending on if any gifts were given over the life of this gentleman, if he still has that full 12 million exclusion, it's going to be excluded from any estate tax, or what we would call a wealth tax. So because it's excluded from that wealth tax, but it's technically taxed, Amy is going to be getting a basis in those shares of stock for $7 million worth of fair market value. Now, let's just say 10 years later, Amy goes and decides to sell that $7 million worth of stock for $7.5 million. Under the current law, she's got a $500,000 gain. Now, let's look at this under the Biden proposal. So when the father would pass away, that stock, this $6.7 million gain that he had made, would be taxed on his final income tax return. Now, under the proposal, they're adding another exemption to this, again, probably to make it more palatable, but there will be a $5 million gain exclusion in this case. And so the total gain that would be taxed on her father's final income tax return under these proposals would be $1.7 million of gain taxed. Now there's kind of a double whammy here. It's capital gains, and Biden, their administration, is also pushing for increased capital gains tax rates to treat capital gains as ordinary income for taxpayers who make over a certain income level. So essentially, those in the upper income level will be taxed more under these plans. That threshold under his proposals is about $1 million in taxable income. And their goal with this is to not have taxpayers hold on to assets until they die, which, as you can imagine, would probably eventually happen. You can also transfer these assets to trusts and things like that before you pass away, to hand them off to heirs or other individuals, or you can sell them. Um, it's definitely a change from what we are seeing now in the planning side, and it'll just be interesting to see how people continue to talk about this and what they are saying about it. Because the way it is framed currently, and I got into a spat over somebody with this the other day on Twitter, is that the stepped up in basis is just a gimme to high net worth individuals, and they need to do away with it because it is creating a wealth disparity. And my reply to that was they didn't understand what stepped up basis is, because it's actually an income tax situation. It's not a wealth tax situation. Stepped up in basis is triggered when you have assets deemed tax in an estate. So essentially, if you're talking about this and changing the stepped up in basis rule, you're really not talking about taxing the wealth of an individual. You're talking about basically initiating a forced deemed sell on properties at death for these taxpayers as a way to punish them for holding onto these assets so they can be taxed in their estate, and in this case use that lifetime exemption. So it's kind of dishonest as to how they're presenting this to everybody. And if they do get this through, you can probably expect more changes that are going to be unfavorable to not only high net worth individuals, but also just regular working class people who are going to be inheriting assets of their loved ones who are entrepreneurs and things like that. So I hope this kind of clarifies the overall framing of this discussion so you can be better informed. So thanks again for watching. Stay tuned for the next one.